Hey y'all, it's Chris Robley from CD Baby, and welcome to the DIY Musician Live. Hey Tessa,
Hello.
how are you doing?
I am good.
Yeah, we got our technical difficulties behind
Mm-hmm.
us. Anyways, today we're going to be talking about something that's probably on a lot of your minds right now, which is taxes
Mm-hmm.
and how musicians should be filing and what they can deduct and all that kind of stuff. So, Tessa, thanks for being here to answer all our questions, every single one of our questions. We're going to be here for
Every
17
question.
hours. Um,
There's
yeah,
so much.
do you want to tell everyone a little bit about how you got into the world of accounting and taxes and all that stuff as a musical endeavor?
Yes. Okay. Well, so basically I was just looking for a job. I just moved to Portland, Oregon, and was just trying to find a job, but um and so really I just stumbled into this tax office because I had a friend that worked there and became a receptionist. And then they liked my job, they liked what I was doing, and so they were like, "Hey, we'll pay for you to take the class if you want to be a preparer here next year." And I was about to leave for tour for the summer, and I was like, wow, like I'd come back and have a real job just waiting for me. That's amazing. And so that's how I got into it. Was I just kind of stumbled into it. I never in my life did I ever think I would have a desk job, let alone doing taxes. But it's something I'm really good at, and it really does work well with a tour schedule because you can work January through April, and then if you need to work a little bit September, October, you can with the filing, the extension deadline
Mm-hmm.
for all of the real procrastinators. And then you can tour all
Well,
of
and it
the,
seems like even in that capacity in your desk job, you get to work with cool musicians. Because I heard of you from
yes.
my friend Tim, who I think you prepared his file for.
Mm-hmm.
Um,
Yeah.
but I was just going to say, I saw a comment on here. Someone's watching from Argentina.
Oh, wow.
And I should say, I'm imagining that almost everything you will tell us applies specifically to the US, right?
Yes, it
Um,
applies to U.S. people who have to file a U.S. tax return.
mhm,
I do have clients that live in other countries that are U.S. people who have to file a U.S. tax return,
mhm.
and so it could apply to them as well. But
Okay,
uh, but not as much necessarily. There's a million different caveats.
right. Well, so assuming someone is needs to pay or get a return on U.S. taxes,
Mm-hmm.
where do you start? Like as a musician, how do you know whether you are a legitimate business in your musical endeavors? How do you, figure out where to start?
Okay. Well, there's a lot of people that are they think, oh, I don't actually have to file taxes until I get 1099s. And that is not true. Pretty much what the IRS says is if you make money, you get paid for something that you did, then you're basically self employed. Or at least they want you to report it. The whole thing of hobby versus self employed, most people listening to this podcast are probably thinking of themselves as musicians who want to make it, would love at some point to make a living off of doing music. And that is actually one of the factors that the IRS looks at is what is your intention? Is your goal to make money with this? Is your goal to be able to live on this? Do you need this to support yourself? And and that there's a host of other there's like a list of 9 different things. But in reality, you get paid to do something, whether it's music or Etsy or selling jewelry or whatever. You are supposed to report all of the income, and then the expenses you can write off on a Schedule C. The one cool thing is the filing requirement. So if people are like, I didn't make any money, and everybody has a different understanding of what any money is, the IRS is any money is dollars. And so
Like
if you,
as in like there's no requirement. It's even if you made $10.
well, there is a filing requirement of $400 of profit.
Mhm.
And so, but you may not know if you meet that filing threshold or not. unless you actually go through the process of adding up your income and then adding up your expenses to see if you had profit or not. Mm-hmm. So if you have no profit, meaning after you add up all of your income and then you subtract all of your legitimate expenses according to the IRS, and you have $400 or less of profit, then the IRS says you don't actually have to file your business taxes. Now, the whole thing with the hobby income is, say you got a 1099 randomly, but you don't plan on, doing this next year or something. It's just kind of a random thing. You can report that 1099 income on line 21 of the tax return, which is basically the other income line. But then it's very rare for you to be able to take expenses. And with the new tax law, I don't know if you can even take any hobby expenses.
So I've heard in the past, even if you have sort of the intent to eventually turn this into a profitable career, and you maybe are claiming losses for a certain duration, I've heard 3 years. After that point, is it true that the IRS will deem you a hobby no matter what?
That is not true. It's like I said, there's these 9 things. I'm going to just pull it up and read it off to you. Basically, I mean, they are kind of nuanced. You could, because, obviously making a living, making a musician, there's no guarantee you're going to make music for a long time. And so in your industry, it makes sense to have losses for a while, especially with touring and all of the mileage that you rack up for touring. It's not unheard of to have a lot of expenses to go with income that was fairly decent to begin with. The different criteria that the IRS look at, and this is in an audit. They're not necessarily flagging you just because you have a loss. But if for whatever reason you trigger an audit, or there's just a random audit, because they do just randomly audit people from time to time, that is one of the things that they're going to look at is, why is this guy taking a bunch of loss? Now, it's one thing if all you do is music and this is what your life is, and you spend all of your time doing this, and then you still add up everything, and according to the IRS, once you've taken your mileage deduction and everything else, it shows a business loss, and you just have like negative numbers on your tax return. That happens. It totally happens, and that's okay. And it shows, hey, look, I'm doing this full time. I'm really trying here. Versus someone who, say, has a job that gives them a comfortable living, and they're just kind of doing band stuff on the side. They're just dumping a ton of money into buying nice gear and spending way more money than they're ever going to hope to get out of this band. Then that person is not necessarily a business. They are a hobby. I do have people coming up to me from different times being like, hey, I just spent a bunch of money on this band. I want to be able to write it all off. And I'm like, oh, well, okay, but you have to show income in order to write all the expenses off, unless you're really in a startup phase, and that's a whole different thing. But in general, you have to report income in order to write off expenses against that particular income.
Interesting. So someone who has like you said, like a W-2 steady employment elsewhere might have a harder time showing that they're,
because then it looks like you're just creating this thing to generate a loss to give you a deduction for your other job.
To offset the taxes you paid on your W-2.
Exactly.
I gotcha.
So back to that list, I'll just read it off real quick of what the IRS looks at. Does the time and effort put into the activity indicate an intention to make a profit? Do you depend on income from that activity? If there are losses, are they due to circumstances beyond your control, or did they occur in the startup phase of the business? And with musicians, it's very easy to have losses. Have you changed methods of operation to improve profitability? So are you looking for different kinds of merch, or are you changing the way you do business or the way you do booking to try to become more profitable? Do you have the knowledge needed to carry on the activity as a successful business? do you even know what you're doing? Have you made a profit in similar activities in the past? So maybe you made some money in a band a long time ago, and now you're trying to start out again, and it's slow to start. Well, that's okay, because look, it seems like maybe you knew what you were doing before. Try it again. Does the activity make a profit in some years? And this is something that I kind of talk with my clients about. If they have a couple of years of losses, and maybe, some years, you have an album come out, one year you're really busy, another year maybe you're not so busy. And if there is a time where maybe you didn't have a lot of activity, you have some things you could write off, but it's not really that important. Sometimes I try to coach people to, you don't need to scrounge for every expense if you already are not, if you're already going to have a loss if you do that. It's okay to show $40 of income or, a small profit, just so that you can stay on the radar of, hey, look, I was kind of profitable this year. It totally sucked, but I was kind of profitable.
Maybe we're getting ahead of ourselves. That leads me to, you finished the list.
Two more things. Do you expect to make a profit in the future from the appreciation of assets used in the activity? So that would be, maybe you're buying all this gear, but maybe the gear is going to be worth something in the future. And that would be one of the things they look at, where you're like, oh, you kind of were seeing this as a real investment. For most people, that's not going to be the case. Do you carry on the activity in a business-like manner and maintain complete and accurate books and records? And that is really going to be the key to the whole thing, is do you act like someone who is trying to do this and trying to pay attention? And I will have to say that most bands, this is their art, this is their passion, this is the thing they care about. They're going to do it whether they make income or not, but they would really, really like to make income. And I know, there's that whole DIY ethic of sticking it to the man. And I know for me, that was really hard to tour for months on end and then walk into the tax office and work and be around all these conversations that kind of turned my stomach a little bit. And, and then I was in this weird dichotomy of, like, I'm on the one hand fighting the man, and on the other hand making sure he gets paid. And
well, when you're paying the man, they're helping make the roads that you're traveling on during your tour.
Exactly.
So it all works
exactly.
out.
That's what I tell people. And also, I justified it to myself by saying, my job is to help people pay as little tax as legally possible. Mm-hmm. So be legal, be honest, but let me help you get the best deductions possible, is what I say.
So on that note, I think you kind of already answered this, but let's say all your income was under the table. What
if
should
all,
go ahead.
Go ahead. I don't want to interrupt. If all of your income is under the table, that sounds like you are definitely self-employed.
But now, what should their own personal requirement be to themselves to report? What is it to the IRS? I mean, I assume the IRS says report every cent of it, and you're not going to advise someone to not do that, I guess. But
my job is to tell you that the IRS wants you to report all of it.
Right. Okay. And then what about, like, someone was asking, I'm in Argentina, but I have sales in the U.S. What is, what would someone like that be looking at? I'm assuming the retailers are covering the sales tax and all that, but
that's not really in my jurisdiction.
Right. Okay.
I would imagine that Argentina would have some rules about what they have to report, because they live there, and a lot of taxes are all based on your tax home, which is your locality, where you live, where you're working from the most.
Sure.
That wherever that is, they have the right to tax you first, and then they work it out amongst. But this kind of brings to another question about bands, U.S. bands who travel to other countries, like touring Europe and whatnot. Basically, what I tell my clients is keep track of all that income and then convert it to US dollars and then report it with all of your other US income.
Okay.
And if you're in a place where, there is a percent of your income that got withheld by whoever was paying you in that other country, there are credits for foreign taxes that are paid. But generally, most of the folks in the DIY world I've come across are not having that issue.
Mm-hmm. All right. So then let's say someone said, all right, I'm treating this like I am a business. It's legit. I'm going to be filing as some form of a business. How do then they decide whether they're a sole proprietor or an LLC or whatever the other options might be?
Okay. So an LLC is a business structure that does not have its own tax designation, meaning if I am talking to a potential client and I'm asking them, so what kind of business are you? And they tell me LLC, I still won't have any idea how to do their taxes because I don't know if they're being taxed as a sole proprietor, a partnership, or a corporation. And so as far as the IRS is concerned, there's 4 different ways generally for people to be taxed as a self-employed person. You can be a sole proprietor, which is a Schedule C, which basically that's what most people listening to this probably are. It's the simplest form of business, and it's I made some money, I have to report it. I'll report it on my personal taxes on this little business form that just feeds into my personal business form, my personal tax form. So that's the simplest. And if you are a single member LLC and you did not file paperwork to ask to be taxed as a corporation or an S corp, then by default you're a sole proprietor. If 2 people, say 2 people in a band, are doing business together and they both consider themselves owners, and then whether you file an LLC or not, you are by default a partnership. And then partnership taxes, that's a Form 1065. That has all kinds of other rules that go with it. Those taxes are due March 15th. There's all kinds of crazy penalties if you don't file it on time. Partnerships are good for some people because they're a simple way to have multiple owners, but there's also a lot of tax that is involved with them, similar to Schedule Cs. And then there's corporations. And most people in a band, any kind of creative service, they're going to be taxed as an S corp specifically, which is a pass-through thing, which basically just means you figure out all the business income and expenses on this business form, and then figure out how much profit there was, and then split that up among all the owners, and they get a thing called a K1, which is kind of just like a big complicated W-2 that says, this is how much of your share of all this income you have to report on your personal taxes.
Okay.
And it kind of leads us into talking about self-employment tax.
Okay. Can I ask one question before we get there?
Sure.
So you said you imagine most people watching are Schedule C filing sole proprietors, and I also imagine that's probably the case for anyone who's a solo artist, performing under their own name, which is my case. So when I get a check that's made out for a series of shows or for a show, and then I have to pay band members, or even considering paying, a mixing engineer or something, and
yeah,
over the course of a year, it might add up to thousands of dollars. You're paying these people. Is it my responsibility to do a 1099 for them? To issue a 1099?
Yes. The rule is if you paid out $600 or more to a person or a business, anybody that's not a corporation, then you are required to file a 1099, basically saying, hey, I paid this person this much money.
Okay.
So if it's less than $600, then you don't have to worry about it.
And that's a way of saying, like, okay, if I received X amount of money, but then paid out, Y amount of money, you can subtract Y from X in order to, that's what my end revenue was for that situation.
Yeah, so you report all the money that came through your hands. That's your gross receipts. If you want to think of it, if you're having trouble remembering the difference between net and gross, you can be like, ew, gross, I have to report everything? Then those are the gross receipts. And then from that, you put on the tax return all the deductions. So there's a spot for contract labor. There's a spot for commissions and fees. So you can put on there, hey, this is how much I paid out the booking agency. This is how much I paid out these band members. This is how much I paid out that random person that did photography. As long as you are filing a 1099 miscellaneous, which basically says I paid this person and they're not my employee, then you can write it off.
Okay.
As long as it's true.
Right. That's a very important thing probably to consider for most of this, right?
And I know that a lot of times people are reluctant to deal with 1099s because they don't want to do that to their friend, or they didn't want to ask for somebody's social security number. But you're in business. You don't want to be responsible for having to pay tax on that money that you gave someone else. So before you pay anyone out, have them fill out a W-9. A W-9 is that thing that says, this is my information, my address, my social security or tax ID number for my business. This is what you use to file a 1099. And that way, even if you maybe don't know how much you're going to pay them throughout the course of the year, you have the information before you pay them, so that at the end of the year, after you've paid them and it's January 15th and you're like, holy crap, I had to do 1099s. Hey, dude, what's your social security number?
Yeah.
And they're like, I'm not giving you that.
And they can't be pissed because they had the fair warning.
Yep.
Yeah. Cool. Okay, so you'd mentioned wanting to talk about, what is it, business taxes, right? Is that what
self-employment tax?
Yeah.
Yeah. This is so maybe if you've had a W-2, which most people have had a W-2 in their life, on a W-2, it has like, this is how much money you got paid, and then this is how much was withheld from your paycheck for federal income tax, and this is how much was withheld for state income tax. And then also on there, it shows how much was withheld from your paycheck for Social Security and for Medicare tax. And that amount that's on the W-2 for Social Security and Medicare tax is actually only half of the amount that gets paid to the government. Your employer actually matches that amount, and then both have to go to the government. And that's what's called payroll taxes. And so if you've ever heard people complain about how expensive it is to have employees, they're talking about that extra tax that's on top of what they're just paying as wages. And so you, being the owner, being the boss of yourself, have to pay employment tax, which is basically the Social Security and Medicare, the employee and the employer half of it, on all of your profit. So that's one reason that business deductions are so great, because you only pay tax on what's profit, which is your income after your expenses. And self-employment tax is 15.3%. which is a lot, because say you worked so hard and you're like, yes, my band made a profit. This is great. And you made $10,000 of profit, which is awesome for a DIY musician. But not that great to live on. And then on top of that, all of a sudden you owe over $1,500 to the IRS. Like, what? That is all self-employment tax. All of that is Social Security and Medicare. And so even though you're below the normal filing threshold for like everyone else that got a W-2, because you're self-employed, no one was paying that Social Security and Medicare tax. So you owe it, even though you barely made anything.
And if you're a sole proprietor who's just a solo musician, does that same, you're your own boss, you have to pay on both sides of it, the employer and the employee?
Yep.
Ouch.
Yep. And so that's why
you mentioned, is there a income threat, or a gross revenue threshold before that kicks in?
Yes, $400.
$400. Okay.
Yeah. So even if all you did was make a measly $2,000, that's still like $300 in taxes that you owe.
Now, would they automatically, is that part of your filing that you are kind of compelled to do just by going through the paperwork, or is it something you have to sort of voluntarily include the information about? Do you know what I mean? Like if I was doing TurboTax or H&R Block or one of those, would by entering in my gains and losses and all that, saying I'm a sole proprietorship, would they just factor it in that I need to pay these taxes?
Yep, that's
Okay.
exactly what happens. They
Okay.
figure out this is all the profit from the Schedule C, and so then that gets figured out as how much self-employment tax goes with that profit.
Okay.
And so a partnership is kind of similar in the sense of all of the business income and taxes gets handled on this separate business form. And then you get a K1 saying, hey, this is how much money you made from this business. Then that also triggers self-employment tax. And so that's why partnerships are taxed a lot, just like Schedule C sole proprietors. And that's one reason a lot of people, once they start making enough profit, that they really actually have to think about managing their income and expenses because they actually really do have a decent amount of profit. That's why a lot of people start looking at becoming an S corp or start being taxed as an S corp, even if they're an LLC, because there are ways to avoid a percentage of that self-employment tax.
Okay. Huh.
But that's a lot more complicated and a whole different discussion.
Sure. Yeah. Interesting. Well, so I don't know if we're veering away too soon from that topic, but I was curious for touring musicians or musicians that might work in multiple states. Like, if you're in Portland, Oregon, it's a good chance you could be having a lot of gigs in Washington. And
Mm-hmm.
so what do you have to do if your income is made in a bunch of different states? You're on tour and you're selling thousands in merch across a bunch of
Mm-hmm.
different, yeah. What?
Well, so there's reality, and then there's what every state would like to see you do. Now, basically, when we mostly think about taxes, we're thinking about federal taxes because that's the rules that we all live under. And so that's the Schedule C, that's the partnership return and the S corp return. State taxes are based on what states you lived in, your tax home. They have the first right to tax you. But then if you do business in another state, that other state will be like, hey, you should pay tax on the money you made in our state. And that's true. Every state says that. And then there's this big thing where you duke it out among the states if you have multiple state income. But in general, that sucks because once you're on the radar for a state, then every year they're going to want to be like, hey, what income did you make this year? Hey, you didn't file your California tax this year. What's up? And you're like, well, I didn't go to California this year.
And are they actually, are there people that are actually doing research to find like who toured through what states and who owes
I
what?
don't think so.
Yeah, okay.
I don't think anybody knows unless a business like a venue 1099s you, and a lot of times the only reason they're going to do that is because they are required to withhold a certain amount of state tax. Some states have a law about that and some don't. And so if you're on the radar for a particular state, then you should file taxes for that state. I guess technically you should file taxes for every state that you work in, but that's crazy if you're not making so much money that it's really worthwhile to be figuring that out because there's state filing thresholds, and a lot of times most people are making below the amount for it to matter. And so I pretty much deal with report all of your income. Let's figure out what your income and your expenses were, what your profit is, and then if we need to split that up between localities or states, then we can look at what states are like the biggest states that you work in, and then maybe just file those. A lot of times, if you were forced to have to sign up for a sales tax thing, like you were at some kind of a festival or some kind of a convention where you were required to sign up for a temporary sales tax license, that normally happens more with craft shows and things like that. But sometimes maybe a band has to deal with that. Then you're going to be on that state's radar, and then they're going to start bugging you for stuff. Okay. But sales tax is a whole different ball of wax. It's totally different than income tax. And there is an app called TaxJar that deals with sales tax. That if you're in multiple states, it is a huge pain, and avoid it as long as you can.
So use the app if you have to.
We're not supposed to tell you that, so I'm sorry. But most of you are going to be so under the threshold that it's not going to make it. I'm going to shut up now.
Oh, cool. So you've mentioned a few times the term Schedule C. Do you want to say what that is and what good it can do musicians?
What kind of good it can do? Well, it's
Like what can you put on it to get money back or to pay less
okay.
taxes?
Okay. I'm going to hold this up. You probably can't see it at all, but that is a Schedule C. And basically, you say, this is how much income I got. If you have merch is inventory, and that is counted in a whole different way than all the other expenses. I'll talk about that in a minute. There's things like advertising. I count anything you're paying Facebook for promoting your Facebook posts, your website costs, your hosting costs, a lot of that kind of stuff I put in the advertising category. If you made flyers, you made promotional materials, I would put that in the advertising section. There's auto expenses, and that is usually the biggest one for bands because there's the tour van or the car, and it's racking up thousands and thousands of miles. And that is normally by far the biggest deduction for bands. And there are two different ways to handle vehicle expenses. You wanted to say something?
Oh, I think you might be about to answer this. I was curious how it differs if it's your own personal vehicle that you're using occasionally for business.
Yes. So there are two different ways to handle vehicle expenses. There's actual expenses, which is you keep track of all of the miles you drive on your vehicle. You also keep track of the business miles, which is like tour and going for errands and things like that. And then you also keep track of all of your repairs and gas and all that kind of stuff, but not just your business gas, all of your gas for the whole year. And then there's a business use percent, which is basically, this is my business miles, this is all my other miles, do a little percent and figure out I use my vehicle 15% for business. And so then we take 15% of your gas and 15% of your repairs and that kind of stuff. And there's also depreciation of your vehicle. That happens when you're using actual expenses. Now, there's actual expenses, and then there's the standard mileage rate. The standard mileage rate is beautiful. It is over 50 cents a mile. It's in that 50 whatever cents it is for that year. I think it's 54.3% for cents for 2018. I don't bother memorizing numbers because they change every year. But basically, within that standard mileage rate, there is a certain amount that is considered for depreciation. That's the wear and tear on your vehicle. There's a certain amount that's considered for gas and everything else. And so they basically figure it out every year. And that standard mileage rate is beautiful and awesome for most people. Pretty much, I tell people the only time, at least with the people that I end up encountering, the only time it's better to take the actual expenses versus the standard mileage rate is if you're buying like a brand new Sprinter and in 5 years you're planning on buying another really expensive new vehicle. Because depreciation on a vehicle is for 5 years. And so taking the actual expenses, which is the depreciation, the gas, all that kind of stuff, repairs, that might seem awesome compared to whatever your standard mileage rate might be. But then after 5 years and your vehicle is all depreciated out and you don't have that deduction anymore, you're not allowed to switch over to the standard mileage rate until you get rid of that vehicle and start over with a new vehicle.
You have to stick with it the whole time.
Yeah, and that's the part that sucks. And so for most people, you're driving a cheaper vehicle that's older. I mean, maybe not, there's a lot of different people out there, but for quite a lot of DIY musicians, you're not driving a brand new Sprinter, and your mileage rate is almost always far and above, and it's less record keeping. You do need to keep track of all of the miles for the year and your business miles. But other than that, you don't have to keep track of all that other stuff.
Which for me, I'm so well. I shouldn't say I'm terrible at keeping records. I do the like cramming for a test version of my expenses. Like I look at
Yeah.
my Google Calendar and
Yes.
my gig calendar on my website, and
Hmm.
then I go to Google Maps and figure out the mileage. And then I'm up till 5 a.m.
Yeah.
sometime in April, and same thing with
That,
my receipts. It's just a giant Manila envelope with stuffed
hmm
full of receipts, and I
hmm
don't know why I do it to myself, but
You're not the only one.
I know
You are so not the only one.
because taxes are yeah.
Hmm. Well, and that's the thing. Nowadays, there's a lot of different apps that are really helpful. There's MileIQ. I know QuickBooks has a QuickBooks self-employed version that's like a super pared down version that's supposed to be for Schedule Cs. That they have a mileage app on your phone for that. So honestly, if you're on tour, it's really easy to keep track of your miles because you're like, this was my odometer before I left for tour.
Uh-huh.
Weeks or months later, this is my odometer when I got back from tour. That one's really easy. But for your day to day, doing errands, meeting people, that kind of stuff, it's nice to have a mileage tracker.
So speaking of meeting people, that was I had a question about entertainment, meals, that sort of thing. What's the rule
Okay.
around writing off, uh, you know, having some drinks with your band for a band meeting, or
Mm-hmm.
any of that stuff, or buying a burger when you're at a gig?
Yeah. So it kind of depends on if you're in town or out of town. If you're out of town, you're traveling. And so any food you buy is work related because you're stuck out on the road. It's not like you could have gone home and made a sandwich. And so traveling meal expenses, your substantiation is just, I was in another town overnight. Um, so you can count, this is the amount I actually paid for eating out. Or to keep things simple, there's a government per diem chart that basically says this is the most that you can claim for overnight out of town business travel. And sole proprietors and I think partnerships are allowed to use this. Other businesses are allowed to use it if they have employees. But if you're a 10% S Corp shareholder or more, then you're not allowed to use it.
Hmm.
And then you just have to have the business pay for all of the food. But for people who are Schedule C, sole proprietor, self-employed people, if you toured, you did all this stuff, you forgot to pay attention to anything, or you were using cash, and you're like, holy crap, I don't have any records. This is one way you can, figure out your mileage. That's an amazing deduction. And then look at your tour schedule, and then look at this chart. And for random middle of nowhere places, you can count $51 a day of meals and incidental expenses. So that's like all your food for the day plus, tipping and any of that kind of little stuff, paying the valet guy or something. That all kind of goes in with that. And so that's awesome because that helps with the record keeping. It's supposed to reduce the burden on the taxpayer.
Hmm.
But it's one of those things most people don't know about. And then when you're actually at home in your local area and you are wanting to go out to meet somebody for drinks or something, it's if you have a defined business purpose, normally that would be you expect to make money from this person somehow. Then you would go and you would be, as long as you have a business discussion either directly before, during, or directly after, then you can generally count it as a business expense.
So
Now, us being in the
simply going to a venue that you might want to play at and buying a drink while you watch a band and then leaving doesn't count?
I would say it counts because it's research.
Mm-hmm.
You're studying your competition basically, or
Okay.
you're studying to keep up in the field. And so actually, I would say that paying for the ticket would count as research, and be in kind of a different category. There is no research category on a Schedule C, so I would normally kind of stick that under like office expenses or supplies or something because it's money that you're paying to keep your game up.
And can you put
but
a Spotify subscription and CDs and books and
absolutely,
all that stuff in there too,
yes,
right? Okay.
yes, as long as it pertains to your field in some way. Like people who are filmmakers, I would say you could count your Netflix. But if you're a musician, I wouldn't count your Netflix unless you're making all of your videos and they're awesome and you're actually making money because of your videos. But the other thing about buying drinks, I would say that the drinks would go in the meals category, and all meals, whether you're traveling or whether you're at home and it's just considered a business networking kind of thing, those are only really half of a deduction. So it's cool because you can still count it, but the IRS is like, oh, you're going to eat anyway. Like you still have to pay for this stuff, but
Right.
maybe it's more expensive because you're out. And so they give you, basically you figure out how much you spent or what your per diem is, all that kind of stuff. And then the IRS will, or when you're doing your taxes, that tax software will cut it in half. And that's the number that actually ends up as a deduction on your tax return.
Okay. So one thing that musicians often buy is, you mentioned merch, t-shirts or CDs and vinyl or whatever, and you said that's
Mm-hmm.
factored differently. There's some kind of inventory depreciation. Is
Yes.
that right?
It's not depreciation. It actually has nothing to do with depreciation.
Oh.
That's a whole different thing. Depreciation is for equipment, and inventory, merchant inventory, which is basically, if you've heard of the term cost of goods sold, that's the category that merch goes in. It's actually on the second page of the Schedule C. It has its own little section, and then it gets figured out on that second page and then gets put back right at the top on the first page. And what it's kind of hard for some people to it's hard for a lot of people to wrap their brain around because it's not the way we normally think. But basically, say you bought $1,000 worth of merch during the year, and then, you know, obviously you didn't sell all of that merch that year. Maybe you sold $400 worth of that merch. And when we're talking about $400 worth, we're not talking about the retail amount. We're talking about, I spent $1,000 on CDs. I got 1,000 CDs. That's $1 a CD. That's my cost. And that's the thing I'm looking at. So if I sold $400 worth of CDs, that means I have 600 CDs left over at the end of the year. And so when we're talking about ending inventory, what we're looking at is, this is how much I had left over at the end of the year, sitting in my basement, sitting in my merch bin, whatever. This is what I have left over for me to sell in a future year. And so your deduction for that merch that you bought in that year, say 2018, even though you spent $1,000, your deduction is $400 because it's the amount that you moved. So even if you like gave half of it away, that's okay because it still counts because you paid for it and then you moved it. But it's kind of hard to think about for a lot of people because basically, though, you have ending inventory of $600. That those 600 CDs that cost $1 each, that is left over. And so when you do your taxes the next year, your beginning inventory is $600. And so that deduction is sitting there waiting for you to take in a future year when you actually sell those CDs. And maybe you make money because you're selling those CDs, and so you need that deduction then.
Yeah, so that's why that whole area confuses me and frustrates me, because it involves year over year record keeping, not just what did I do this year, but then you have to remember what your previous
totally
filings contained and all that.
And so it's really helpful for you at the end of December or the beginning of January, go through all of your merch and add up, like, this is how many of this t-shirt, and this is how many of that t-shirt, and this is how many of this record. And, you know, keep a spreadsheet or a little paper or something where you write that stuff down so that you have it. And it's also really helpful when you're buying merch. You know, if you buy t-shirts, it's not just this is how much the t-shirts were. It was like, this was the setup fee, and this was my tax I paid, and this was the shipping to get those shirts. All of that you paid this money for those shirts. So all of that counts as what your cost per shirt is.
Okay.
You figure all of that in.
Right.
And
Okay.
and so then maybe it's $8.32 per shirt. I'll write that down so that you can figure out your ending inventory, because then it's however many of these shirts are at the end of the year times $8.32.
And then you pray there's not hyperinflation or deflation.
Uh-huh.
Cool. So you had you'd sent me some notes before this, and you talked about the importance of having a home base in order to take the mileage deduction. Did you mention that?
I haven't yet. Actually,
okay.
That's super important.
Okay.
And so this is one of those things that it's just one of those weird IRS rules. They basically say, in order for you to be considered traveling away from home, because all of these travel expenses, like the mileage rate and hotels, if you're staying in hotels, all of that stuff is your expenses because you're traveling away from home. And so they say you have to have a home in order to be traveling away from. So if you don't have a home, meaning like a tax home, meaning like this is where I make money and this is where I pay my taxes, and an address. You need an address. And so basically the idea is that you are responsible for keeping up some living expenses somewhere, so that you can show, hey, look, I had to spend all this money staying in somewhere else, but I'm responsible for this place at home. So if you live with your parents and you don't pay any rent, see if you can get one of the utilities in your name, or see if they will be interested in writing up a little silly rental agreement that shows that you owe them $50 a month or something. Something that can show, if you have roommates, something that shows that you are responsible for paying rent here sometimes. And so maybe you got a subletter while you were on tour. You're still responsible to make sure that rent gets paid, whether you paid it or the subletter paid it. Something like that, so that you can have documentation. That's the thing that's important with all of this IRS stuff, is documentation. Like whatever thing, if you buy something off of Craigslist, you buy a $500 piece of equipment, write it out on a little piece of paper. On this day, I bought this thing for this much money from this person, and have them sign it. And then stick it away, scan it in your computer, take a picture of it, whatever you need to do. And that's a great thing, actually, taking pictures of your receipts. Since we live in this digital world, could be easier for some people than keeping a bunch of papers.
That's
maybe not. You can also just keep a giant manila envelope in between the seats in the van and shove all the receipts, every day.
But it's such a headache at the end of the year.
Yeah.
So speaking of having a home, at least on paper, what about people who have like a practice room or a basement recording studio or whatever? What can they do to deduct some of that?
Yes, this is another really, really, really great business deduction. So you have your mileage and you have your food when you're traveling, and then you have a home office. And if you can have those three things, that is like most of the things. The home office deduction, it doesn't have to be an office necessarily, because you're a musician, maybe you don't have an office, but maybe you have a practice space or studio, or this is the band room, this is where we keep all of our gear, and this is where we practice. The idea is that it has to be exclusively used for business, meaning it's not your living room, it's not your dining room table, it shouldn't be your bedroom, unless you are in a situation where you live with other people and your bedroom is the only room that you can do anything in, it's yours. Then sometimes I will, if the circumstances are right, I'll say, well, okay, this little 5x5 area right around your desk could be counted as that, because this is legitimately where you do all of your work.
Tape it off.
Yeah, but in the IRS, it can, and that's one of those things where it depends. If you happen to randomly get audited, you might have an auditor that thinks that's totally okay. And then you might have a different auditor that is like super stickler because there wasn't walls and a door. So that's just one of those things. Yeah, it's like having any other kind of thing. People's personalities get involved.
Hmm.
But in general, your best efforts to be honest and true are important. And so your basement, if that's where you guys practice, um, or a spare bedroom or something. And the way the home office deduction is figured out is you actually get a tape measure and you measure out the square footage of the room, and that's 9 feet by 12 feet, and you multiply that together and that's your square footage. And so that's the area of your house that's used for business, and that number goes on the tax return. And then you figure out the square footage of your whole house, which is usually on your rental agreement, or you can look it up on the county or Zillow or whatever, it maybe. And so then that, just like with the actual expenses with the car, you figure out the business use percent. This many square feet divided by this many square feet equals my office space is 10% of my house, something like that. And then all of your rent, all of your utilities, if you pay homeowners insurance or renters insurance, that kind of stuff, if you paid for repairs, all of those things get to count as a business expense, but only according to that business percent. So if your home office is 10% of your whole house, then 10% of your utilities and 10% of your rent all get to count as a business deduction, which is amazing.
Does the same business use percentage principle apply to like your cell phone and internet?
No, it doesn't, because your cell phone has nothing to do with how much the space in your house is, and generally your internet.
I don't mean that it's tied to the percentage in your house, but more like you have to keep track of saying like, oh, well, I use my cell phone 25% for business.
Oh, yeah. I would say that for internet and cell phone, they are definitely, you can count them as a business deduction. You should definitely not count them 100%. And so, yeah, it's supposed to be based on the hours used, but nobody's keeping track of that. And so I pretty much just say, hey, it's your best estimation based on what you know about your life. Like, how much are you using your cell phone for business? And so a lot of times people will be like, I don't know, not that much. I'll be like, well, you have it with you on tour all of the time, and it's your only means to connect with anything. You're using it as a GPS. You're looking up stuff. You're buying things on it. It's not just talking on the phone. Like, you're using your phone for a lot of business stuff. And so, and even occupying yourself while you're on tour. And so you can generally, if you're using it a lot, you can claim a really high percentage. And I would even say maybe like 95% if you're just on the road all the time. If you're not, then maybe a smaller percent. And the same with internet. If you're spending a lot of time on the computer at home, booking shows and promoting and that kind of stuff, will by all means count a large percent of your internet bill. But keep in mind, you're also streaming Netflix in the living room and other things. And so it's not 100%.
Uh-huh. If it is 100%, take a break.
Yeah.
Do something else.
Yeah. There's actually this really weird old rule that I believe is still in effect, even though it's like kind of crazy now. But the IRS, before cell phones, everybody had landlines. And so everybody had a landline, but then maybe you would have a second landline for your business. And so the IRS is like, nobody's allowed to deduct their first landline. You're only allowed to deduct your second landline for business. And nowadays, nobody even has a landline unless it's for business.
Right.
But technically, you're not supposed to deduct that.
Interesting.
So anyway, count your cell phone.
Maybe that'll be changed in the overhaul next year.
I sure hope so.
Cool. I don't know if you had any more detailed things to offer that you think would be helpful. I was just going to ask kind of a general advice for how people should keep track of things through the year, and then how they should prepare their filing at the end of the year.
Okay, I have a couple other business deductions that I could go over. Say if you have insurance on your gear, definitely count that. There's a whole space on the tax return for insurance. If you have health insurance, does not count as a business deduction, but if you are not getting insurance through a regular job where they're taking it out pre-tax and that kind of stuff, say you got it through the government marketplace, or you're just paying out of pocket or whatever, is something called the self-employed health insurance deduction, and that is pretty cool because it's not as good as having it paid through work, but it is still something. Basically, you enter it and it shows up on your 1040 on your personal taxes as an above the line deduction. So what that means is it makes your adjusted gross income smaller. So it doesn't factor into your profit or loss of your business. It's not a business deduction, but it is a deduction that does reduce your tax because it makes your adjusted gross income smaller. And so that's awesome. So, but it's different than instrument insurance and travel insurance and things like that.
Cool. Okay.
And also, say you pay somebody a bunch of money to do your taxes, because business taxes can be expensive. You do get to write off a portion of that. You're not really supposed to write off the entire amount, but the part of the bill that was related to the business portion of the taxes, that is a business deduction. And then just normal stuff like office expenses and supplies and cables and sticks and gear, like small gear. Oh, we didn't talk about depreciation really.
Yeah. So if you buy a big, a $4,000 guitar,
yes.
how does depreciation work? And can you take the whole $4,000 hit on
yes.
that purchase?
So there's a couple different ways to handle it, depending on what your needs are for that year. So if you got a $4,000 guitar, you can depreciate it over time. Musical instruments are depreciated over 7 years, which is kind of a long time. And so that basically means you can't deduct that $4,000 all in 1 year. You have to split it up over 7 years in this, this way that the computer will figure out for you. But you can say, that sucks. I actually made a bunch of money this year and I really need that deduction now. Then there's something called the 179 expense, which basically says, okay, you can take it all this year. But you have to, say that in some special way on the computer and it'll do it. The thing about depreciation is, say you expensed that $4,000 guitar this year, and then 2 years from now, you just stop the band, stop doing business. You're not in business anymore. You have taken this instrument that you have placed into business service. Now you're taking it out of business service. Even though you already wrote the whole thing off, there's something called depreciation recapture that comes into play there, where it's basically like, terrifying. Hey, it's so dumb, it's awful. But it's basically, hey, you got this whole deduction, which is supposed to be over 7 years. We let you take it this first year. Well, now you got to pay back some tax on that benefit you got. And Ouch. So anyway, that's not something you figure out. That's something somebody like me figures out.
And so if you did have a big purchase for gear, how do you determine what's best for you between those two avenues? Is it one's better if you happen to have a bunch of profit that year, or?
Pretty much. I look at, does this person seem like they're going to be in business very long, or is this like a random thing? Or
if you get the sense they're not going to be in business very long, is it better
then I would
to do
depreciate
the year-over-year depreciation? Okay.
Yes. Yeah. And even within that, there's the stacked where it's more the first couple of years and gradually gets less. And then there's a straight line, which is very even the whole way through. And they all have different consequences and things. And so sometimes I will look and see, like, do they really need this deduction? I think they're probably going to make more money next year. And so I might spread it out further depending on what they need. Or if they have a big loss, I might do straight line so that most of that deduction gets to be in future years. But that's the kind of stuff that I can play around with. And that's why you can have two different people doing your taxes and they come up with different numbers, because there are all of these variables that we get to play around with depending on what you think is best and what we think is best. And oh, that's another thing I was going to say is if you do hire a professional to do your taxes, which I would recommend at least your first year or two of being in business, and that way you can kind of be trained to know what to be doing and to know how to do it, like as far as keeping track of stuff, what's important, knowing what your tax return's actually supposed to look like so that you compare it to whatever you're trying to do on your own later. I think those things are really important. But you also need to have someone who is going to ask you questions and not just take what you give them. There are quite a lot of people who will just be like, they gave me this spreadsheet, I'm just going to put those numbers on, like those people actually know what they're talking about, and not ask any questions and not look into, hey, this number seems really weird. What did you actually put here? Or, wow, these are really round numbers. I can tell you just made all this stuff up.
Yeah, so, and then it's a reasonable thing, it sounds like, to expect that your tax professional would be running the numbers a bunch of different ways and playing.
Maybe I don't know. Maybe I care.
Kind of playing with variables a bit.
Maybe I care too much, so I don't know if that's just me caring about my people. I see my as as to give them the least amount of tax possible. But there are also people who don't care about that. They have the money, they want to pay, they just don't want to think about it. They don't want to have to do any more homework. They just want to be like, here, I gave you these numbers, deal with it. I don't care what the outcome is, just let me pay you so I don't have to think about it anymore. There are those people, and sometimes I think I annoy those people because I'm like, why don't you just go look at your mileage one more time? I think that there's more there. And so that's me just learning what that person actually wants. But if you are wanting the lowest return possible and you want the best return possible, then you should not be afraid to ask your preparer questions. You are paying them to do a service for you. So ask away. You're the one that is getting the service. And if you feel like they're not asking you enough questions, like, hey, I don't really know what I was doing when I gave you these numbers. Please, make sure it seems right to you. Like that's important.
Well, here's a real basic question then. What is someone paying for when they get obviously all of that care and concern, but are they paying by the hour, or are they paying simply like a flat fee based on the filing, or is it a percentage of the return? How do most?
Okay, so it's illegal to charge. It's illegal for me to base my fee based on what your refund is. That I could have major fines for doing that. So if somebody does that when they're just filing your taxes, then don't go to them.
Because then they'd have an incentive to lie to get you a bunch of illegal money. I got you.
Yeah. Okay. There are different ways, different places do it. Bigger firms like CPAs, they might charge more hourly. Smaller places or independent places might charge by the form. I got trained in Oregon, and Oregon has some of the strictest guidelines as far as this industry is concerned. A lot of states don't actually have any regulation at all. Anybody could do taxes and get paid for it. So be careful there. But Oregon has some very strict guidelines. And one of those things is that you charge by the form, and you actually have those prices listed on your website or in your store or whatever. Because that's where I came from, I tend to charge by the form, which is hard when giving a quote, because then I would say this much for the 1040 and then this much for the Schedule C, but then this much for the depreciation, and then maybe if I have a home office, it's this much. So I tend to give a very broad between this and this number until I actually know what is going on with your particular situation.
Cool.
So it's wildly varies depending on who you talk to.
Interesting. Yeah, and then I liked what you were saying about when you're kind of getting the hang of this, just work with a professional for a few years, and then maybe if they feel like they can take it on themselves, what would you recommend then? Like TurboTax or H&R, any of those
Ooh,
softwares, or just
um,
just sit down with the forms?
I would say I'm not familiar enough with those different softwares. I
Mhm.
would say one of the things that annoys me about those softwares is that they don't actually let you look at the tax form. So you're entering in all these numbers. You have no idea where they're going or what they're doing. You just see this little tally go up and down of how much your refund is or how much you owe. And and so unless you know enough about taxes to know like why are they asking me this question? Like, what are they trying to get at when they ask me this question? Then you're just, I don't know, it seems good to me to answer it this way. And you have no
Right.
idea what's happening. And so, whatever software you use, I would recommend paying whatever the fee is. But before sending it to file, I would like look at the forms if you're able to. I
Okay.
don't know how they all work, but try to look at the forms, look it over. It might not make sense to you because you're not familiar with the forms, but you can at least be like, hey, I thought there was something that was supposed to go in this box and it's not there. Where's my home office deduction? You know, that
Uh-huh.
kind of thing. It's good to really see if things are showing up how they're supposed to. I know particularly with TurboTax, I've noticed in the past people who have a rental house they either somehow manage to not have depreciation or they end up double deducting their mortgage interest and things like that. And I think it's just because the same question gets asked in these different places and they don't really know where things are going. And so it's, know yourself, know how diligent you are and how much you pay attention when you read instructions and that kind of thing.
Cool. Well, so you must be in the middle of the craziest time, right? You got 2 weeks left to
Yes, I
get
am
it started.
super behind on all my tax stuff. But and that's something too. Like if you contact someone now saying, "Hey, I've got this business. I'm self-employed. Here's a bunch of information," or "Hey, what do I need to get you?" It's very likely, even though you think you're so far ahead of schedule because you have 2 whole weeks until the deadline, you're actually really far behind as far as tax people go. And so it's very likely that you will be met with, "I would love to file an extension for you."
Uh-huh.
And I will help you figure out how much you owe. Ooh, this is something that's important. So a lot of people don't know about extensions, but basically the deadline this year is April 17th. And so if you file an extension, that basically says my deadline to file this was April 17th. Now I got permission. I can wait till October to file this. But any tax that you would have owed on April 17th is still due on April 17th. And so then you're like, but this is crazy. Like, how am I supposed to know how much tax I was supposed to pay? And the answer is, you should estimate it or figure it out or at least try.
Huh.
And that's where somebody like me would kind of like give me your best guess or that kind of thing.
And if you didn't pay it at all, and then you filed in October, would you have like an interest payment or a late fee or some kind of penalty?
Yes, you would
Had
have
you owed money?
yes, you would have a failure to pay penalty. You would have interest. You would you would owe more than you would have if you had just paid something. And it's kind of like withholding. Like when you have a W-2, you're an employee, and they withhold regularly from your paycheck. If you pay too much, you get that back at the end of the year. And so the same thing when you're self-employed, you could pay into it throughout the year by paying quarterly taxes. Quarterlies also, they're known as estimated payments. And it's estimated because you're like, not really sure what it's going to be until the end of the year when I actually do my taxes.
Hmm.
But it seems like right now I'm making enough that I should pay in $1,000 or pay in $500 or something. The IRS really likes it if you owe less than $1,000 at the end of the year. So the goal is to pay in with quarterlies something so that you will owe less than 1,000 at the end of the year.
Hmm.
And like I said before, self-employment tax racks up really, really quickly. And so then on top of the self-employment tax, which was that 15.3%, you have the federal income tax, which is whatever your tax bracket is, on top of that 15%.
Hmm. Yeah, you're
So,
reminding me. I've had, W-2 employment for a long time now, so it doesn't affect me. But I remember um, a lot of friends who weren't paying that quarterly thing, and then just at the end or at the come tax time, just really hurting with having to come up with all this money that they had kind of not budgeted for.
mm-hmm.
Should have been, of course, but just then it's like, crap, where am I going to come up with all this? And
Mm-hmm.
so don't stress yourself out. Pay a
Yeah.
little at a time.
Yes. And also, there's no shame in filing an extension. Businesses, there's a lot of information to gather. This is a lot of stuff to get together, and you're busy running your business. And so this isn't the thing that's foremost on your radar. So if it takes you a while to get this stuff together, or maybe you just need to wait until you're off of tour or something, like file an extension and then deal with it in the summer or deal with it in the fall. Just make sure that you've paid in whatever tax you think you might owe. And if you paid in too much, then you get that back at the end of whenever you file.
Mm-hmm. Cool.
I also wanted to say if there's any people out there that do taxes that are music people, or people, if there's anyone else there like me, please contact me, because there are very few of us and it'd be really cool to network or something.
It's I have a friend in Oregon who's a dentist, and he's kind of known as like the rock and roll dentist because he's got a band, and so he's been pretty good. I don't know if he's actually recruiting them or if just he has some musician patients that told other musicians. Anyways, he's kind of like
Mm-hmm.
the rock and roll dentist. You're the rock and roll accountant, right?
Totally. And it happened through that. Like, I was working at a little mom and pop office in Portland, and then I had a little business on the side, and then we moved to Kansas City, and then that little business kind of grew and became our main thing. And it mostly started with people who knew us from the band, and
Mm-hmm.
then kind of spread from there.
Well, that's awesome. Have you been? Well, I don't know if you can even say. Have you been working with Tim?
Tim Huggins?
Yeah.
Yes.
Oh, cool.
Yeah, he's a
Such a
cool
good
dude.
guy. Yeah. Well, I wish you luck in the next few weeks with your mountain of filings that you have to do.
Uh-huh.
Thanks so much for hanging out with us. Let me see. Do you have a second? I just want to go through the comments real quick and see if
Oh
there's.
yeah, absolutely.
Okay, let's see here.
I blocked out everything for you.
Taxes are way too complicated and time consuming for our family now. We have had
Yes.
Tessa do ours for 2 years now. Well, there you got a
Oh, neat.
testimonial
Yay.
from, let's see, Corrine.
Oh, cool.
Um, let's see. Here's the guy, Barry James. He says, as a first-time CD Baby artist, if I make less than $50 profit as a hobbyist, do I need to report it? Which I think you answered no, right? Only if you make $400 or more.
Well, so if you are really considering yourself a hobbyist, then yeah, you're supposed to put the money down as other income on line 21. But if you're really considering yourself self-employed, then the threshold is $400. It's kind of a weird, like, who would consider themselves a hobbyist at that point then. But
Yeah, right. That's interesting.
the real kicker is if you got a 1099, because if you got a 1099, then you have to report it even if there's a loss, because the
Right.
IRS will know, and then they'll be like, hey, I know you got at least this much. What's going on there?
Mm-hmm. Yeah. Lots of considerations here. Cool. Well, I think those were most of the questions, but I'll go through the comments again after this is over and see if I missed anything, and
Okay.
either refer people to your site, or I can try my best to give you completely unprofessional tax advice.
Mm-hmm.
But yeah, thanks again for hanging out, and hopefully when Folk Alliance returns to Kansas City, I will get to hang out a bit more.
Awesome. Great.
Yeah.
Thanks for having me. I love getting to talk to people.
Well, yeah, I appreciate it, and I love the Star Trek posters behind you.
Thank
Are
you.
they both? What are they made of?
They are paper and velvet.
Oh, nice. Very good. Cool. Well, I'm just going to make a couple announcements, and thanks again.
Okay, cool.
Take
Thanks.
care. See ya. So yeah, thanks to Tessa for hanging out with us and answering all those questions. I had a personal announcement that leads me to some CD Baby news, and the personal thing is I'm putting out a new single this Friday, April 6th, called "Collapsing Star," and you can pre-save it right now on Spotify by going to bit.ly.com/collapsing star. I'll put a link in the comments after the broadcast is over. But it's a song I'm excited about. It's sort of a David Bowie-esque tune that's maybe mixed with like Death Cab for Cutie kind of influences. But I'm excited to put it out. And if you pre-save it, basically what happens is you click a button. If you're a Spotify subscriber, it will be added to your song queue right now, even though it's not available yet. And then on the day it becomes available, it'll be in there in your song queue for you to hear. And so, that helps me obviously because you're hearing my song. But the other thing it does is it gives me a longer window before the release of the song to build up people who are saving it to their own music queue. And so on that first day when it is released, basically all of those people will hopefully hear it. And that does a little spike on the first day streaming activity for the song. And then that's the type of thing Spotify is paying attention to. Their algorithms are searching for that kind of thing and to see that the song has immediate traction and interest. And then based on that, they will start to serve it up to other listeners, whether they're my followers or people who listen to similar kinds of music, put it in their algorithmic playlists like Release Radar or Discover Weekly. Yeah, so that's the benefit to me. You have to get to the CD Baby announcement part of this. You can do the same thing. CD Baby acquired a company called Show.co about a year and a half ago. And it's a really cool suite of marketing tools that are used by major labels. And we've made them available to CD Baby clients for free. You can do a bunch more than just Spotify pre-saves. There's a whole bunch of different kind of campaign types. But recently we made that Spotify pre-save functionality free for all CD Baby artists. When we first launched the tool, it was not free because we had a few things to work out. But anyways, now that it's all golden, you should check it out. Go to your CD Baby dashboard, and there's a link that'll lead you to show.co to create an account and play around with it. Create a pre-save, or if you're not, maybe you've already got music out, you can do a Spotify save account, which is similar. It's just basically leading people to your music that's already live. You can do a campaign where you offer something in return for something for someone following you on Spotify. A whole bunch of stuff to try out. So anyways, go into your CD Baby dashboard and create your show.co link. And please pre-save my new song, Collapsing Star, by going to bit.ly.com/collapsing star. And lastly, CD Baby is still celebrating all year long our 20th anniversary. So you can get worldwide distribution of your music for the same price it would have cost you in 1998. We've returned to our original price to celebrate. And we're also offering a $20 discount on CD Baby Pro, which is our publishing administration service, so we can collect your songwriter royalties on top of the royalties you're already getting for your sound recording. So check that out. Go to members.cdbaby.com/promo, and you'll see both coupon codes for those standard distribution and for pro publishing, which also includes all of our standard distribution stuff. Yeah, so that's the news today. I hope you'll tune in again next month. Towards the end of the month, we're going to have a discussion with a couple people at CD Baby who are on the design side of things to talk about album artwork and the sorts of things that are good decisions based just on aesthetics and what's eye-catching and going to work for you. And then also some things not to do that'll get your music kicked off of iTunes and Spotify and places like that. So hope you'll tune in then. And once again, thanks to Tessa for hanging out with us, and I hope you have a great, wonderful time over the next 2 weeks scrambling to get all of your taxes done. It's a pain in the ass, but maybe you get some money back. Anyways, take care.